Hello, everyone. This is Jean-Marc from Funding Gates, and today what we're going to cover is how to set and adjust credit limits to your customers. And so basically, it all starts with setting up a scorecard. And you know your customer's credit risk better than anyone. And setting up a scorecard is the first step. And so typically what we see is that businesses, they set up around 5 categories when setting up a scorecard, which consists of the financial strength of the customer, the credit scores of the customer, financial information of the customer, the management team, and then any macro kind of industry, geography, market dynamics that are going on. So for every category, you can set up a number of points, right? Typically varying from 0 to 100. And then you assign a weight to each category, ranging from 0 to 100%, right? So basically what comes out is a score, like a weighted rating for each category that you then sum up, and then you know where the customer falls, in which risk bucket, basically. So an example might be, that you've assigned 54 points to the financial strength of the company. You've assigned it a weight of 40% for that overall category. And so therefore there's a weighted rating of 22 points. And then you do this for every category as seen over here. And then you sum up all the points over here. And that comes out to a score of 42, which falls in the above average risk bucket, basically. So there are a number of different ways that you can calculate the credit limit for customers, or at least figure out like a band for the credit limit. And one of the ways is basing it off of your customer's cost of goods sold. So basically the cost of goods sold from your customers is the total amount that, as a proxy, they're purchasing from suppliers and vendors, etc. And so if you can figure out what your customer's cost of goods sold is, either on the phone call or if you have access to their income statement and financial statements, right? You get their cost of goods sold, and then you divide it by 365 days, and to get the daily cost of goods sold from your customers, and then you multiply it by the terms, whether it's net 30 or net 45 days, right? To get essentially the total exposure, right, on the customer's payable side, right? What they're purchasing from suppliers and vendors. Now, it's up to you and your risk tolerance on how much of that exposure you're willing to take on, right? And that's how you set your credit limit. So let's say, for example, your customer's cost of goods sold is $200,000, and you divide that by 365 days. That gives you $550 in cost of goods sold per day from your customers. You multiply that by 45 days, which are the terms, and the total exposure, therefore, is $25,000. Now, depending on where the customer falls in the ranking over here, right, based on your customer scorecard we did earlier, you can adjust how much of that total exposure you're willing to take on or willing to supply, right? So if the customer has an above average credit rating, right, you start at 20% risk exposure, and you might go up to 35%, right? And as you build a relationship with the customer and they're paying on time, you can always adjust that credit limit, right? Or if the customer is a great customer and falls in this area over here, in this bucket, then you can increase the willingness that you're willing to supply on the total exposure, which might go up from 60% to 80%, right? Or $14,000 to $20,000. Another way to calculate credit limits, it's based on the customer's net worth. And you get that number from the balance sheet, right? So basically, the way net worth is calculated, it's basically the customer's total assets minus total liabilities. So over here, you have current assets, right? Fixed assets, total assets is 460,000. Liabilities is 321,000. This minus this is 139,000. And then typically the credit limit ranges anywhere from 5 to 15% of the total net worth, right? So again, the credit limit range can vary from 5 to 15%. So 5% times 139,000 is around $7,000. 15% of $139,000 is around $21,000. So that's another way to come up with a band for the credit limit. Another one is the asset test, which is basically the debt to equity ratio. And it shows how much leverage, how much loans, and how much debt is already on the customer's books, and whether they have the cash flows to repay that loan, right? Because the banks and the creditors, they're going to get paid first, right? And the suppliers and vendors after. So if your customers have a lot of debt on their books, you want to know that, right? So typically, if the debt to equity ratio is around, 1 to 3, that's great. They're not very levered, right? That's great. But if the debt to equity ratio is 2 to 1, then that means that they have a lot of loans on their books, and so in case anything happens, banks are going to get paid first. And so you can also adjust the credit limit percentage like that as well, right? So if the debt to equity ratio is 1 to 3, right, then you can go up to 15%, for example, right, of the total net worth amount. If it's 1 to 1, adjust it down to 10% times the net worth amount, which is $14,000, etc. So that's another way to create a band on the credit limit. Another way is to look at the trade references and bank references of the customers, right? So you can call up the bank references, ask them, let's say it's 4 banks, right? How much credit they extended to this company, right? And then you can see what the average is, the median, low, and high, and then trade references, right? Other suppliers and vendors, what their credit limit is to this customer. And then you can take the average, median, low, and high, and then combined banks plus trade references, right? You have a pretty good sense on the average, the median, low, and high. Again, this gives you a pretty good band on the credit limit range. And then the last one is you can also pull credit reports, commercial credit reports from Dun & Bradstreet and Experian. They also give credit limit recommendations, right? So over here, for example, you see DNB's report. They give a conservative credit limit recommendations of 85,000, et cetera. And then Experian as well. Minimum credit limit, maximum credit limit, right? This gives you another kind of sense of what the band is for the credit limit. These are all different data points, right? There is no single one right way, but these give you like tools and methods to figure out, kind of like extrapolate what the credit limit band should be for a particular customer. That's it for today. I hope you enjoyed the series, and stay tuned for more content.